Hello again, and we're continuing our online video lecture series in AGRC 219 Ag Finance with Unit 11, and we're going to talk about capital and the use of credit. So let's get to our content here. The objectives of this section, I will let you read on your own. You're welcome to pause the video if you like, but we're going to talk about how to utilize credit and capital in the correct manner, hopefully, and some concepts and approaches to taking out loans and some of the critical pieces of loan structures and things of that nature. So from an introductory perspective, when we talk capital, and if you hear a banker or something like that talks about capital, is it just cash? And it's not just cash. It is investments in things like I've listed here: land, cattle, facilities, equipment, and any other things that you have that count as capital, things that are worth something, so to speak. And then credit is certainly important to capital acquisition. So occasionally you don't have enough in that capital or that cash reserves to go purchase certain things. And so you have to reach out and acquire credit and utilize credit to do so. And sometimes many of your suppliers will allow you to purchase inputs on credit and gives you kind of a repayment window. So let's talk about some of these two concepts here. So when we talk about sources of capital, where does it come from? Of course, owner equity, so your capital. Outside equity, if you have investor capital, so there's another source. You can lease equipment and lease things, which provides some flexibility for you because you don't necessarily have to take out a loan, so you're not paying interest. But how reliable is that? Occasionally, when you lease like equipment, for example, you can often pay a really exorbitant amount if you're not careful about the terms of the lease. So it's sometimes higher than what you would pay in a payment. So you have to be really careful about entering into leases that you're utilizing that tool the correct way, so it doesn't actually cost you more than you think you are saving. Of course, you can contract services for payment, like custom work is a great example. That's a good way to acquire capital and also sometimes save yourself money. Custom combining is a great example of that. If you actually do a study of combine ownership, and there's a great tool on University of Illinois FarmDoc website that helps you really do a study of combine ownership, and you'd probably be surprised about how many acres it takes to actually probably support the ownership of a combine. And you actually see another good example in Clinton County of custom chopping, custom forage harvesting. There's quite a few custom forage harvesters that go around and serve other producers and free them up from having to own their own forage harvester. So there's some good examples of that out there, but that allows you to, if you're the one that's contracting out those services and providing that equipment for other people's use, that's capital for you. And if you are one that's contracting for those services, meaning bringing in somebody custom combine for you, then that's, you of course have some money up front that you've got to pay them, but you also don't have that combine payment and maintenance and header cost and things of that nature that you would have to take care of if you own that piece of equipment yourself. Next is, of course, source of capital is credit. And if you need to quickly increase your business size or capitalize on an opportunity that might come available to grow, maybe you need to improve efficiency of resources. Let's say you have a 20-foot grain table that's probably reached its useful life and you need to replace it. And you're looking at potentially trading it in on a 30-foot grain table that's going to, of course, have much greater harvest capacity, but it's also more expensive. You may need to use credit to purchase that item, and therefore it increases your efficiency. It's going to be much less time spent during the harvesting process with that piece of equipment. And you can spread your purchases over time a little bit. You don't have to lay out all that money all at one time. Moving on, if we talk about types of loans, you can look at length of repayment loans, whether it's a short, intermediate, or long-term loan. Like a short-term repayment loan would be a line of credit or something of that nature. An intermediate-term loan might be a car loan, and of course, a long-term loan, the greatest example, is a mortgage. You can also look at uses of loans, whether it's real estate, non-real estate, or personal use loans. But generally speaking, lots of loans come with security. And this is primarily for the lender to have some kind of assurance that they can recover the loan value. So a secured loan is an asset. You're going to have an asset or some bundle of assets utilized as collateral. And an unsecured loan is maybe you're a borrower with exceedingly good history of repayment with that lender. And we call that a signature loan. So there would be not necessarily a secured loan. Something like that might be on a much smaller loan. Maybe you want to take out a small $5,000 home equity loan to build a new deck on the back of your home. And you've got, it's going to be a very short-term loan. You've got great history with your lender, and it's, I sometimes call those a handshake loan. You'll walk in, provide the plan, ask for the money, good handshake. Here's the check for the loan. Go out and build yourself a deck and pay us back over the length of time that we agree upon. Something like that. I think those are shrinking in terms of availability. Those were much more common years and years ago. You can also look at repayment plans, and there's several different options here. Of course, you could pay off a loan in just a single payment, so where all of the principal and any accumulated interest is paid off in one lump sum, so like an operating note. We can also look at a line of credit, which is very common in agricultural operations. So the funds are available and then drawn down as needed, as requested by you, the producer, to make available to pay off a chemical bill or pay off a fertilizer bill or something like that. And there's oftentimes not necessarily a fixed repayment plan. Generally speaking, you need to pay those off on an annual basis or make good on them. Next is what we call an amortized loan. So a periodic principal and interest payments. Think about a car payment here, or a pickup truck payment, or a real estate mortgage payment. So they can be of equal total payments or equal principal payments. So there are different structures that way. Most commonly, you'll find them as equal total payments. And so if you look at an amortization schedule, early on in the loan process, so if you take out a real estate mortgage of a 25 or 30-year mortgage, fixed interest rate for this example, in the early years of your mortgage, if you look at the proportion of the payment going to interest versus principal, it will be much higher interest and very little principal. And then about halfway through the loan, you'll see an equal amount principal and interest. And then as the loan begins to reach its maturity, then almost all of your payment, let's say it's $1,000, almost all of that $1,000 would be a principal payment and very little interest. So as that loan reaches that maturity, the interest amount is dropping rapidly. So that's the most common in terms of, I think, vehicle loan and mortgage or real estate loans. Lastly, that I have listed here is what we call a balloon payment loan. So it gives you some flexibility in terms of payment size at different times. Now, certainly an intriguing option. So for example, let's say we set up a mortgage loan on a balloon payment schedule, and the first 5 years, our monthly payment was $500 a month. And then after 5 years, it balloons to $1,000 a month. So it obviously gives you some flexibility. Like if you're just getting started in your career and you want to go buy your first house, those have been popular at times. Now, the really hang up with some of those is really about lack of planning. So obviously in those first 5 years, that $500 monthly payment in order to meet your house payment works pretty nicely in your budget, maybe as you're not making quite enough money. But by the time year 6 reaches, you have to be planned for that ballooning up to $1,000. And so sometimes you find individuals that struggle with that balloon payment. And so make sure if you enter into a balloon payment loan that you understand very clearly how that's going to work, when it's going to balloon, and you better make sure that you can meet your payment, or you're going to have to go through a refinance in order to make it work better. So where can you get a loan? Where are your sources at? Well, of course, then the most common is commercial banks. And in terms of non-real estate loans, like your pickup truck or a personal loan or something like that, they've always been the single largest source of those non-real estate loans since commercial banking became popular. But they're increasing in the real estate market rapidly. They're garnering much more of that land market. Also, of course, you've got the Farm Credit System that is a government-supported entity, again, providing an additional source of credit to farmers, and it is operated as a cooperative, so you can get patronage return on your investments there when you do business with a farm credit type company. Next is life insurance, and many don't know that you can secure loans in that regard, but life insurance companies, their funds come from premiums paid on policies. And they prefer generally large real estate loans. This wouldn't certainly, of the ones listed here, this would probably be the least of my choices on a personal basis. And if you are going to consider a life insurance backed loan, make sure that you look into the options carefully in terms of how it's structured and whether it's worth it and the risk that it comes with. Farm Service Agency, or the FSA office, certainly provides a source of loan funds, and every county has an FSA office that you can go to for small or short-term loans. You can borrow against the grain that's in the bin and secure it that way, and then when the grain moves, the check first gets cut to the FSA office to secure your loan, but it maybe allows you to stretch out when cash is needed versus when cash when grain should be sold for its best value. So there's a number of different loan options that FSA provides to you. Utilize those when they fit good for your operation. They're nice tools. And then, of course, you have individual or suppliers that can be a source of loan funds. Outside investors is one possibility. Again, be careful as you enter into agreements with them. That you can secure those things appropriately and not put yourself at too much risk. And finally, time repayment on services rendered. So, occasionally you'll find individuals that utilize their supplier as a source of loan funds, actually. And so they'll stretch out for many years not paying off their bill and accruing that interest, and will only make periodic payments just enough to ensure that you can continue to do business there. And some of your ag retail locations have occasion to have trouble with things of that nature. So that is an option to kind of a method that some use to loan funds. So when we talk about establishing and developing credit, it's certainly a hot topic. You can find lots and lots of commercials out there that talk about credit development, things of that nature. So let's talk about that here real quickly as we kind of reach the end of this video clip. First is personal character. Keep a great, honest, open relationship and operate in an honorable manner, and most lenders will be glad to do business with you and be glad to help you along the way, especially as you're starting out young. Do a great job and have high personal integrity. That'll help you work with a lender with success. Sharpen up your management ability. Lenders occasionally observe one's ability to manage operations. You'll see lenders loan officers that like to come out and tour the farm, and they're not just out there to have a good day with you necessarily. They're sometimes checking in to see, does the farm look well kept? Are your crops in good condition? Are they clean? Is your equipment in good repair or as good as it can be? They're kind of judging their risk to do business with you based upon your management ability. Keep a good financial position the best you can. Have really accurate balance sheets and income statements and very good records. And as you meet with lenders and loan officers and financial advisors, they also judge you based upon the quality of the information that you supply to them. So as we've been talking about and practicing through this semester, if you can supply them with a really good balance sheet that's clean and has correct data on it, you're not overinflating values of pieces of equipment, and you're not fudging numbers on what you owe for certain things, they're going to begin to trust you that, you're in good financial position. They're going to look at repayment capacity. Is cash flow available to repay loans as you enter into them? Some are going to question the purpose of a loan. Do you really need to take out this loan? And does it serve a really good purpose for your operation? And then finally, the collateral, which we've already kind of referred to a little bit, of course, is going to be used to guarantee loans. And in the, hopefully rare occasion that you have to recover that value in case of a default. So that concludes Unit 11's lecture, video lecture here on capital and the use of credit, and certainly a tool that you should utilize. And it's important. Notice I kind of left out here developing a credit score. And, there's a lot of differing opinions on that. Some will really encourage you to get a credit card, take out, which is essentially a loan, and then repay it, and then it'll make some random score go up. I would caution you to be careful with something of that nature. Because going into debt so that you can go into more debt, is generally not a great approach and not a successful approach over the long period of time. Building up cash reserves and operating in utilizing debt as a tool only, not as an operational method, is really a much better approach in my experience. So occasionally, and we know that the requirement for cash and capital in agriculture is so expensive to buy pretty much everything that you need on the farm nowadays. There's very few bargains to be found. So building up piles of cash is difficult to do to go out and purchase an asset. So it's oftentimes necessary to utilize credit, but just be really careful about how you enter in and when you enter into those loans, and the quicker that you can pay them off. For example, just as a personal example, my wife and I, when we bought our current home, started on a 30-year mortgage, and whenever we got about 5 years into that loan, the interest rates had dropped significantly, and we had the opportunity to refinance our loan and save a lot of money on interest. And actually, we dropped ourselves from instead of going back out to a 30-year note or staying at a 25-year mortgage, we were able to drop down to a 15-year mortgage. And actually, our house payment stayed almost exactly the same from month to month when we made that change. And we quite literally shaved 10 years off of our repayment schedule of interest that we would have paid. And so we will have paid that loan off, instead of in 30 years, we will have paid it off in much closer to 20, and maybe as we've gone along, about 17. So that's going to save us several $100,000 in interest, and we'll be able to take that cash and go do something else with it over the long term. I'm not bragging about that's what we did. We just had the opportunity come across to get ourselves in a better loan position. And I would encourage you as a young person, especially getting out there in the agricultural market, and then as you get into your home loans, be very careful about how you enter into loans, when, the terms of repayment, and so forth. It will help you be much more successful. I hope that's been a helpful little video lecture here. And as we get back to class and talk about utilizing credit, we'll look forward to working with you on some assignments. Thanks for tuning into this video.